This is today's Daily Market Comment by Mario Sotiriagos. I'm Christina Marujos, and thank you for joining us at XM.com. The Federal Reserve hit pause on its tightening campaign yesterday, keeping interest rates unchanged. Nevertheless, the FOMC added a hawkish twist to the decision by signaling 2 additional rate increases for this year in its dot plot of rate projections. Almost everything pointed towards a higher for longer path for rates, and in an attempt to cement this notion, Chairman Powell even said that any rate cuts are a couple of years out. Yet market participants did not buy it and essentially reacted as if the Fed was bluffing. The disbelief was reflected in most asset classes, with the dollar closing the session in the red and stock markets erasing some early losses to storm higher despite the hawkish message. One way of reading the market reaction is that investors are not as rosy as the Fed about the economy and think a weaker data pulse of the second half of the year will prevent the Fed from executing on its plans to raise rates further, therefore shifting the emphasis on incoming data to decide who's right. The dollar index managed to recover some ground early on Thursday with some help from rising treasury yields and a sinking Japanese yen. It's been a dreadful week for the Japanese currency, which has already lost 2% against the euro and sterling to hit new multi-year lows, crushed under the boot of central bank divergence. It seems like traders are front-running the Bank of Japan decision tomorrow, where there isn't much scope for policy changes. While inflation and wage growth have fired up, the Bank of Japan is not yet convinced this strength will last. That could change in July if the bank's updated projections show inflation staying above 2% over the entire forecast horizon, but for now, policymakers will likely keep their powder dry. Gold is exhibiting some signs of relative weakness as it was unable to capitalize on the retreat in the dollar and yields yesterday, but then slipped to a 3-month low today as those moves reversed. There might be some sovereign selling in play, for instance with China or Turkey unloading some gold to stabilize their currencies. As for today, the spotlight will turn to the European Central Bank decision. A quarter-point rate increase has been widely telegraphed and is already fully priced in, which means the reaction in the euro will depend mostly on any messages about future moves. With the eurozone already in a technical recession and signs that inflation is moderating rapidly, the central bank might shift to a data-dependent approach and indirectly open the door for a pause next month, which could disappoint the euro. Thank you for watching the Daily Market Comment here at XM.com.